Today you're going to deal with S12, S2 inventories, right?
Okay.
It's S2 inventories, and if you do remember when we are studying A16, we spoke about inventories a bit, but also when we did some later standard, we also spoke of inventories a bit, and now we are actually into the standard itself. It is just easy, right?
Okay.
Yes, it is just easy since you already started studying about the PPEs on undergraduate 16. You went through impairment, so it would be very easy and very direct. Okay.
Okay.
So I hope you know
Exactly.
what inventory is, right? Inventory can be in actually different forms. It could be in three different forms. It could be something that is complete. It could be a finished good, right? A finished what?
Okay.
A finished
Good.
good. For example, goods purchased for what? For resale,
Very
right?
good.
This is just an example. Goods purchased for resale is an example of a finished goods inventory, but also it could be a work in progress. Maybe you're manufacturing something and at the end of the period it is yet to be completed. So you say that it is a work in what? In progress, WIP, right?
Okay. Yes.
But you could have something in as fresh as just taken from somewhere. Let's say maybe you are trying to make tables, right? Furniture. But maybe you just went to the trees and cut down the trees and you only have those one, right? It's not like you
Yes.
already have the what? The timber is timber, no. You just have the raw material, so you can say that's raw what? Materials and
Yes.
components used in the production what? Process. So that's
Okay.
an example. These are the common forms, right? Finished goods, work in progress, and raw what? Materials, right? But here I just decided to mention some different forms. For example, you can look at this one. It's called finished goods which have been manufactured. Of course, even if it has been manufactured, it's a finished good, but also here goods purchased for resale, we also presume it to be finished what? Finished goods. So it's the same form. So that's why generally we have three forms: finished goods, work in progress, and raw materials. So what are
Materials.
inventories in general? Inventories are current assets. Are current what? Assets. And
Asset.
that's why we say they are held for sale in the ordinary course of the what? Of the business. If you're holding something for sale, it means you don't expect to stay for much or for a very long time with it, right?
Mm.
Yes. So we define every term, but also they are used in the process of production for such sales. You see. They are in the
Okay.
form of materials or supplies to be consumed in the production process. So we speak of finished goods, we speak of work in progress, we also speak of raw materials, right? That's all.
Materials.
You can
Yes.
see all these definitions. They just try to cover all forms of inventory. Yes. So it's just direct. Usually, no, when we deal with inventory adjustment, for example, normally in the trial balance, in the trial balance, whenever you have the debit and credit side in the trial balance, right? These are the particulars.
Yes.
Here the debit side, here the credit side.
I.
We usually have the word inventory. Whenever we find the word inventory here, normally when you have inventory, you would also have a line for purchases. For what? Purchases.
Okay.
Yes, I'm presuming maybe we're not speaking of we're not speaking of manufacturing company. We speak of a merchandising company which buys goods and sells them outright without having to modify them. So in case you find the word purchases here and the inventory, this inventory should be the opening what? Inventory. That's what it is.
Inventory.
Yes. But
Okay.
but in case you might find yourself in some cases in exams, you don't find the word purchases, but you find the word cost of sales. In the trial balance, you find the word what? Cost of
Cost of
sales.
sale.
So if you find the word cost of sales, and here you're just provided with the word inventory without mentioning whether it's closing or opening, this should be the closing what? Inventory. So
Inventory.
beware of this matter. You have cost of sales, line of cost of sales, this should be closing inventory. You have a line of purchase, this should be opening what? Inventory. And we have the
Inventory.
reasons, of course. Do you know the formula for getting cost of sales? How do you get cost
Yes.
of sales? Uh-huh.
Cost, cost of
Equals what?
sale is the opening
Uh-huh.
inventory
Plus
plus purchase
minus what? closing inventory.
Minus closing inventory.
Yes. So
Yes.
if you say minus closing inventory, it means if closing inventory comes to the right, it will be added, right?
Yes.
You see now, so you get the point here. Closing inventory plus cost of sales stays as cost of sales, while opening inventory stays as what? Is added with what? Purchases.
The
You see.
purchase.
So that's why
Yes.
in this trial balance, you find the word purchases, the inventory within that should obviously be the opening what? Inventory.
Balance.
You find the
Okay.
closing, the cost of sales, the inventory within there should be the closing what? Inventory. You shouldn't expect
Inventory.
anyone to tell you about that. I hope that is fine.
Oh,
Right.
okay.
Yes. They're just simple matters, most matters, to capture about inventories. It's not a big deal, but you have to know it because I don't think there is any exam that you'll come out of without having faced the inventory issues. It's difficult not to
Okay.
find that. Yes. Okay,
Okay.
now we have the year-end inventory adjustment. It's just normal adjustments, like I've shown you in that trial balance, right? The closing inventory is what goes to the statement of financial what? Position, right?
Position.
Yes. Now, as I told you, in the trial balance, usually you will have the opening inventory, which is the closing inventory of the previous period, and you will have the what?
Yes.
The purchases. This is normally the case.
Purchases.
Yes. So if this is normally the case, although not necessarily, but in the case you have something like this, it means at the year end, we do the inventory count, we confirm our closing inventory, and we pass necessary, entries, right? How do we do that? Closing inventory stays as a current asset in the statement of financial position, right?
Position.
Yes. So it means that we usually go to let's say we have counted our inventory and the seen that, okay, our inventory is worth $2 million, right? So I'll say debit
Yes.
inventory 2 million in the statement of financial position.
Position.
And then I come to the income statement and I credit cost of sales. Cost of what? Of sales.
Fulfill.
Cost of sales, it is a cost, it is an expense, right? Because it
Yes.
is shown in the income statement. And so that's why when you deal with the previous figures, you remember cost of sales, we said it's opening inventory, right? Plus what?
Yes.
Purchases. And
Purchase.
so we usually deduct the closing inventory. Now you can understand why. This is what we usually do, right? You debit inventory,
Yes.
2 million in the statement of financial position, and then you go and the credit cost of sales. Cost of sales is of a debit nature because it is an expense. And because we usually deduct closing inventory from it, it means that we credit cost of what? Of sales
Of sales.
by the same
Okay.
figure of
Almost
2
I
million.
see that.
Okay? So I hope you
Okay.
can see that it is what I've written here, right? This one.
Okay.
Yes. So you just notice, okay, when you do the income statement, you do this, and then maybe now what about the opening inventory? About the opening inventory, I think now we can also say that okay, this is just obvious because remember now, this was the closing inventory, but for the future period, for the next accounting period, it would be the opening what? Inventory,
The
right?
opening
Yes,
inventory. Yes.
it will be the opening inventory. So this is what we're going to do. You just have to do the opposite, right? So as for the
Yes.
opening inventory, it would go like you see, opening inventory is added to what? To purchases. And we also know purchases is an expense, right? So that's why
Yes.
it's the reverse. Opening inventory is debited to cost of sales, which means if you debit something to an expense, it increases an expense because an expense itself is of a debit nature, right?
Yes.
Yes, and then we credit to inventory what? Assets. So whenever you have any form of inventory, you credit it, you remove from it because you have debited it. So simply speaking, you can come from this common matter and then for opening inventory, you do the reverse way, right?
Yes.
Although it's rare to encounter the entries of opening inventory unless maybe there was an error or so. Maybe that's when you have to know this is what I would have done. The common one is should be this one, right? The closing what? Inventory. Closing.
Inventory.
So it's just that way. And then we go to measurement of inventory. Measurement, as I told you, whatever asset you recognize in your books, you have to know its worth, its value. Otherwise, you just end up saying, okay, I have to recognize this asset at what value? You say, I don't know. If you say, I don't know, you don't have the right to recognize it, right?
Yes.
Okay, so measurement of inventory, like I told you, to do this, I told you that when we're studying a statistics impairment of assets, I told you that that standard on impairment of assets doesn't apply to all standards. It only applies to those standards which do not implicitly or do not by themselves explain how to get impairment of the assets. And the ISO inventories was one of them. In ISO inventories doesn't need a statistics impairment of assets, right? It does
Yes.
compute its own impairment loss. And you can observe
Okay.
this measurement of inventory. Inventories is usually measured at the what? At the lower of cost and net realizable what? Value. If you go
Value.
back and you see about I-36, like I told you, you have to know to understand the relationship between the standards if possible, right?
Okay. Yes.
Say that whenever you compute impairment loss, you compare the carrying what? Amount
Amount.
against the recoverable what? Amount.
Amount.
And for the recovery amount, we said you take the higher of the two. You know, impairment loss statistics explains about non-current assets. And when you have non-current assets, you have two ways of recovering funds from it. You can use it,
Mm.
at which point you will save value in what? In use,
Use.
but also you could just sell it outright, at which point you say fair value less cost what? To sell.
Yeah.
Fair value less cost what? Let me just
Yeah.
write C, cost to sell. You see now. So
Yes.
when you deal with the same inventory, you have to resort to the same matter and understand, right? When you deal
Yes.
with the inventory as a current asset, you cannot expect to gain value from using the current asset. The current asset is not used, it is sold, right?
Yes.
So as for current assets, you won't have this. So I'm putting an X here, right? And so
Okay.
I only remain with current carrying amount and fair value cost to do what? To sell. This fair value cost to sell is what we call net realizable what? Value at this point.
Value.
And this
Value.
carrying amount is obviously what we're going to call the cost. See that? The main difference
Yes.
maybe under non-current assets is like we usually have the cost, but we depreciate it maybe, right? That's why we see the difference.
Yes.
But it's just the same thing. So I hope from now, someone asks you, okay, how do you measure inventory at
Mm.
the law of cost and net realizable? But not say, I've forgotten. While if they tell you how to get impairment, you say can get it. If you find that you are in that situation, it looks like you don't even know the connection among the standards. You just try to memorize.
Yes.
Sometimes you may wonder, someone knows, they know what they have to do, but they don't know if they know. And the next, okay, so the situation now. I hope you can just by saying this, I think everything will be clearer for you now. How do you get
Yes.
net
Yes.
realizable value? You see, at what price can you sell something, and what are the incidental costs of making that asset actually to be in a sellable condition, right? And actually sell it.
Yes.
That's the net realizable value. It is an estimated selling price in the ordinary course of the business, less the estimated cost of completion in case it wasn't ready, obviously. It means you'll complete it, and then the estimated necessary cost to make the what? The sale. Necessary
Yes.
cost.
Sir.
It should be only the costs that were incurred to enable the sale to occur, right? Not whatever
Yes.
cost you incurred. If you incur a cost to be apart from those which are necessary, you don't have to count them in. Yes. So it's just that way, right?
Yes.
Okay, now it's okay. Look, now it's like in the case of inventories, this amount could fall below cost item, which when you have damaged items, it's fine. Like we spoke about, I explained events after reporting period, right? We said that
Yes.
the asset might have cost 10 million, But maybe its net realizable value might end up being 8 million, at which point we take the lower of the two. So if we take the lower of the two, it means I'll have to state the asset at how much? At 8, because I have to take the lower,
Yes.
right?
Yes.
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 So maybe I'll just know, let's know the principal situations in which net realizable value is likely to be less than what? Than cost.
Good.
What are those situations? There are just a lot of reasons, why should this, you find any reasons which make, remember you said that net realizable value equals to selling price or fair, which you expect to be at fair value, less the cost, right? So whenever the costs are
Yes.
higher or the selling price is low, it means that value, that fair value, that NRV will be lower, right?
Yes.
That's why you're told an increase in cost, which is obvious, or a fall in selling what? Price. This has just
Value.
been taken from the formula itself, net realizable value, selling price minus the what? The incidental cost, which are equal cost to sell, right?
Yes.
A physical deterioration in the condition of inventory. Isn't this obvious?
Yes.
You had the inventory in store, maybe it has been deteriorated, maybe upon taking it out of store, or maybe upon storing it, maybe it was damaged, for example, right?
Yes.
Obsolescence of products. The product has become also obsolete. Maybe it has stayed for so long, and actually maybe new and superior products are currently there, or maybe the product can't function as it once was able to, something like that. So it's obviously its rate will go down. If the rate go down, net realizable value goes down. If NRV goes down, of course, we would have answered your question. But also maybe a decision as part of the company's marketing strategy to manufacture and sell products at a loss. You know, this could be this could be a strategy. Some companies do this, right? You know, some companies
Yes.
might want to fend off competitors, or maybe they may try to stop new entrants from entering the market. Most new entrants maybe they won't be financially stable, but they will be trying to find a way to penetrate the market. So among the barriers they might encounter are like maybe the established companies which know that, okay, if I let this new entrant in, I might end up getting a lot of loss, a huge loss. So they decide that it's better I prepare for 20% of the loss than having to incur 100% what? Loss. So maybe
Love.
they decide to produce a product and sell it at a loss. Just by selling it at a loss, it helps as a barrier to new entrants, so new entrants won't enter the market, right?
Yes.
Because their products won't be bought, because the new entrants maybe
Okay.
they're not financially well, so maybe they won't want to get in the market and sell at a loss, right?
Okay.
This
Okay.
happened. This actually happened, although it wasn't an inventory direct, it was a service. There was someone, it is, on something called Lake Victoria, if you understand, if you know about it, Lake Victoria, here in Tanzania,
Yes.
happened.
Okay.
So there was an established guy, he was transporting people at a given price, and then the new person came, and to gain people, he reduced the price considerably. Doing that
Oh,
actually started affecting the established person. And so the person said, okay, this person actually, I know that he's just using this strategy in the short term because he can't proceed with that price forever. So what I'm going to do, I'm
yes.
going to get him out of the market totally. I'm going to ship people for free.
Oh no.
So if people started doing people for free. So, people, you don't have all people shifted from that guy and they came to the original guy. They are moving for free. After 2 weeks,
Oh
that guy
no.
had to go and beg for forgiveness. So please forgive me. I didn't mean to do
That
this.
was a good treat.
And so
Okay.
you would have to arrange the price and I would follow. Then the guy told him, okay, it's fine. I'm going to arrange the price, but also, I suffered a lot of losses. So you're going to pay me the losses. So it means all the money the new guy amassed when he had reduced the price. He had to pay all that money, and in addition,
That was the treat, a good treat.
Yeah. So this business has a lot of issues. You might just end up laughing. So it's just something like this.
Okay.
Yes. And also
Okay.
the other point you are told errors in production or purchasing, right? Errors in production or what? Purchasing. Of course, if you made an error in production, it means the good won't be worth is what you expected, right?
Yes.
Yes. Won't have maybe the same quality, and so you won't expect to sell it at that original price you had intended. Okay, now let's go to the cost of inventories here. Cost of inventory, it's just the same, of course, just a bit like what we did about PPE, but we just need to study, each study has its own way, but you just have to focus on what is needed, right? Cost of inventory.
Yes.
We have said that we measure inventory at the law of cost and net realizable value. We have seen how to obtain the net realizable value, but we are yet to see how to obtain the what? Cost. And that's why here we are. Okay. The cost of inventory will consist of all the following costs. It is usually subdivided into three categories. So the purchase, obviously, when you go for the inventory, you have to know the purchase. That is obvious. Even if it is a non-current asset, you do that, right? Cost of
Yes.
conversion and other costs incurred in bringing the inventory to the present location and what? And the condition.
Condition.
For non-current assets, we usually say the cost directly attributable to bringing the asset to its working condition, right? Because that non-current
Yes.
assets have to work, but current assets do not have to work. We just need to bring them to the present location and the condition and the way to be solved, right? So you can know, okay, when I go to
Yes.
non-current asset I-16 PP, this same statement would be there, but they would specify the word working condition because non-current assets have to do what? They have to work to generate
Correct.
funds. But inventory doesn't have to work. Inventory is just stay there, it be made ready for sale, sold, and generate the funds. Yes. Okay, so what
Okay.
follows, we
And
just
this conversion?
converge. Yes, we are going to see that all. So we are going to see the first,
Oh,
the second, and the third. But generally, before reaching there,
okay.
if
Okay.
you have ever done management accounting, we have these components. We have materials,
Yes,
so
I have.
which we usually like to call direct materials, direct labor,
Yes.
and what?
Direct labor
And overhead.
and overheads.
So by this now, this is what we say. We have direct material. For example, maybe there you'll start, maybe you have a table, right?
Yes.
The carpenter has done his job to have that table ready, but there are materials, that table, just by seeing, you can see that we have the timber was used, right? You can see
Yes.
all in the other components there. Okay. So that's what we call the what? The material. And that is what we
Material.
usually purchase. We purchase the materials, right? But
Yes.
the way you have seen it, it has been converted to the table because you initially had only
Ah,
timber. Yes.
okay.
And so the
Okay.
conversion costs are the costs that are incurred to make that raw material a finished product, right?
Yes.
So conversion costs could involve the direct labor and what? Overheads.
Overhead.
Yes. So you can get the point.
Okay.
Okay, this is how it's done. Okay.
Yes.
Yes, but also here we have actually specified maybe other costs incurred in bringing the asset to its present location and condition. So maybe these overheads maybe could have been broken down twice. Maybe some overheads are here on conversion, but some are not on what? On conversion, right? That's why I just try to specify all other costs. You may have incurred any other costs. For example, maybe the carriage inwards, right? You know about the
Yes.
carriage inwards. Maybe okay, you have received
Yes.
the materials here. Maybe you have transported them from one place to another, right?
Yes.
Of course, although that could also be incorporated directly to the purchase, but you could still have other costs which have been directly specified. Okay, this cost was incurred to make the asset actually in its present location and what? And condition. Right.
Condition.
Yes. Okay, now let's look at one point after another. Cost of purchase, like I told you, you would have to have the purchase price, which is obvious, import duties and the other taxes, just like we said under 16 PPE when we're explaining how to get that cost. We say the non-refundable import duties and the other non-refundable taxes. The same here, right? If the
Yes.
tax is non-refundable, it means you have to presume that you actually incurred that cost. If you are refunded, it means it's like you did not pay. Maybe it was just a way of doing it, but you are going to be refunded. So it can be part of your cost because they will refund it to you, right?
Yes.
Maybe you have done all that. Maybe you purchased something from outside the country, you incurred the import duties and the other taxes. You purchased it from outside, but then if it is at the port, you need to take it to your location, right? Or maybe to your warehouse.
Yes.
So obviously you have the transport cost. Okay. You don't transport them from
Yes.
nowhere. Maybe you have to load them on the vehicle and unload them when at the destination point. So you'd have the handling cost, right? And any other cost
Mm.
directly attributable to the acquisition of finished goods, services, and what? And materials,
Material.
whatever. Yes. Now we have to less any trade discounts, rebates, and other similar amounts. Simply speaking, if maybe you pay for the tax and it is refunded, you may also consider it as part of a what? Of a rebate. Rebate is
Rebate.
what you pay
Okay.
for, but actually maybe you are refunded, right?
Okay.
If you are provided back
Okay.
with something, it means that you didn't incur that cost. Like I told you, trade
Okay.
discount should never be part of the cost of what? Of anything, right? Because
Yes.
a trade discount, it means that it was just on show. You are told, okay, this product now is now 20% off. That is just a trade discount. They're just trying to attract you to go there and buy, right? You can
Yes.
tell me that this product you have reduced 80% of it, you only pay for 20%. That is a lie. Who can do that? That is never an option. Okay, now we go to the cost of what? Of conversion. I think I've told you about it already, right?
Yes.
Cost directly related to units of production, e.g. direct materials. They are not speaking of direct actually you have to focus on direct labor more, right? Because when you speak of the purchase price, it is usually like we deal with that we deal with what? With the materials direct, right?
Material.
Yes.
Yes.
Maybe you can just take it because we may have the main materials and maybe the secondary what? Materials. Like when you do produce something
Okay.
and maybe you have to package, some items are produced and then they have to be packaged. The primary
Yes.
packaging. I'm not speaking of the secondary packaging. Uh, for some industries, for example, manufacturing company, it is a norm that whatever is produced has to be packed in boxes. So those boxes are also form part of the direct materials, not indirect what? Materials. So you could also include it
Material.
here, right? Yes.
Okay.
But also now, but the main point here, you should focus on what? On labor.
Labor.
Materials cannot convert, right? Cannot convert unless maybe you have those materials, maybe which are just used as part of making something red. Yes. So we have the fixed and the variable production overhead. So we just spoke of overhead here, right? Fixed and the
Yes.
variable production what? Overhead.
Overhead.
When you have the cost and you need to know the cost of inventory, of course, we will first focus on production department and then the other departments. As for the other department, there will also be overhead, but not production what? Overhead. Production
Okay.
overheads are those which will be incurred in the four walls. We usually like to use the term four walls, although that is wrong. We could have five walls. We could have a pentagon room. It's possible, right? Can't you have
Yes.
a triangular room? Do you necessarily have to have a rectangular room or a square room? It could be a pentagon room, right? It could be a triangular room. So, simply speaking, those costs incurred in the walls of the production department, right?
Yes.
So, but these things are for management accounting. So, in inventories, I assume they won't have to make a lot of problems for you, but they are just matters which are always there. Variable costs, are usually given on a unit basis. So, you just look at the number of units and you multiply by the variable cost per unit, you get them. Fixed costs are usually given in total, right? Right.
Okay.
Oh, yeah, that's just the case. So, we can have the fixed it. Actually, they do not change for the whole accounting what? Period.
Period.
So they are given in total, but the variable ones are just common for each unit. Maybe they're the same per unit, but if you increase the unit, they also increase. One unit, maybe you have $10. Two units, $20. Three units, 30 what? Dollars, and so on and so on. And so for fixed production overhead, since maybe you may be told, okay, they are worth $100 million, 100 what? Million. And maybe you
Yeah,
need to get the fixed cost per unit. How can you get it per unit? You look at the common capacity of the production facilities. Maybe you are told that, okay, it is worth 10 million, $100 million, but usually we produce 100,000 what? Units. This is normal capacity. So if you do divide here, you're going to get 1,000, right? You're going to get what?
yes,
$1,000
housing.
per unit. So it's okay, my fixed production overhead is $1,000 per unit. So you can add to the variable cost per unit too, and then you can add to the direct labor, direct material, and get the full cost of the one with the product. But this is more management accounting based, right?
Okay, yes,
Yes. And then you have the other costs. Now, like I told you, whatever costs are responsible for bringing the asset to their present location and condition should also form this, right?
yes,
So as long as the question tells you that, you would have to include it. But now,
okay,
the following costs should specifically be taken as what? As an expense in the period they incurred. You see, just like for PPE, abnormal amounts of wasted materials, labor, or production what? Processes, abnormal amount. Maybe you did something, maybe you had to use 2 kilograms, but you have used three because maybe labor is incompetent or materials were of a lower quality. So you can say that I have used 3 kilograms, while in reality, 1 kilogram is a loss, right?
yes,
So whatever materials which were in excess, you have to expense them. But also storage costs, let's say except costs which are necessary in the production process. Presume that you have produced the good and it is ready for sale, but maybe the customer is yet to be found. So it means it will still have to stay in store. Staying in store, you have to incur the cost. So those costs cannot form part of that product. If you do that and the product stays for much longer, it means the cost of the product will keep getting higher and higher and higher, right? Which is obviously
yes,
wrong. Yes. And then you have this administrative. Whenever you see the word administrative overhead, then nothing have been specified that they are directly involved in bringing the asset to location and condition. Simply speaking, when you are told about this administrative overhead or general overhead, they do not form part of the cost. Even under PPE, we said that unless the question specifically tells you that maybe they were incurred with the sole purpose or they are directly attributable to bringing the assets to its location and what? Condition for us to invent,
condition,
or if it be for a 16 PPE, they are directly attributable to bring the asset to its working what? Working condition.
condition,
Yes. But also maybe the selling cost. Let me tell you one thing. Whenever the asset is ready for sale, right, you cannot
yes,
capitalize any cost. This is
okay,
the full stop. So the selling cost, it means the asset was ready, it was in store. When you're going to sell, maybe you have to pay, maybe you're paying the selling agent, maybe you pay them sales commission, and then you say you add the cost. That's not possible. That's obvious, right? If even when
yes,
in store and they were ready, we did not include the cost, how can you include the selling cost? This too is obvious. But it's better to have an understanding.
okay,
Okay, so now I hope you can see that they are just no more matters. Defining cost, this before and article, no big deal on this cost, but even this first question here it's also no big deal. You're told to get the net profit. They won't ask you. I just did this just as a reminder. How to get the net profit for the year, right? I'll just pick it. Uh, Actually, I won't be serious about this. I just put it just as a reminder, right?
okay,
Freeing trading is typically clocks, imports, and sales clocks. He pays for the cost of delivering the clocks from his supplier in Switzerland to his shop in what? In Wales.
well,
They resell the clocks to other traders throughout the what? Throughout the country, paying the cost of carriage for the consignment from the business premises to his customers. Okay? And we are told that on 1st July 2025, he had the clocks in inventory valued at what? $17,000. And during the year to 30 June 2026, he purchased more clocks at a cost of this one. Carriage inwards amounted to this one, and sales for the year are this one. Other expenses of the business amounted to 56,000, excluding the carriage outwards, which was simply speaking, I won't deal with this, but I just need you to get the difference in carriage outwards and carriage what?
Inward.
How can you differentiate these ones? That's what I need. That is an important point. Carriage
Okay.
inward forms part of cost of inventory, right?
Yes.
Because when you are buying something and maybe you need to pay for the certain amount for the inventory to be taken to its present location and the condition. So it means it is the cost directly attributable to taking the asset to present location and what? And the condition, right? But
Condition.
carriage
Yes.
outwards does not form part of cost of an asset. If you carry the assets outwards, it means they are ready for what? For sale,
For
and
sale.
then you take them out. And as I told you, when the asset is ready for sale, you can no longer capitalize anything on them, right?
Yes.
So carriage outward is a normal expense, is a normal operating expense, while carriage inward forms part of cost of what? Of inventory. You get that?
Okay.
Yes, so that's what you need to. Getting the profit is easy because we just take the sales and then deduct the expenses, but you need to categorize them properly to know this is the cost of sales and this is maybe the operating what? Expense. That's the most important point. Okay, it is going to end soon, and so